Hello everybody, I'm Danielle Keynes, and today we're going to work on a few problems of Chapter 1, E1-14, E1-15, and E1-16. So they are preparing the major financial statements for a business. So the account balances of Wilson Towing Service at June 30th, 2020 are as follows. So they've given us all the account balances, and they're asking us to prepare an income statement, a statement of owner's equity, and a balance sheet. There are three problems. So the first thing we want to do is, these are all the accounts, and the first thing I would do is break them up into, are they an asset, are they a liability, or are they an owner's equity account? Because depending on the type of account it is, that determines which statement that it's going to go on. So let's first classify them, all these accounts, as to whether it's an asset, something the business owns, a liability, something they owe, or owner's equity, which is what the owners own in the business. So equipment is something that the business is going to use into the future. It's going to last for a long period of time. It's a resource. So that's going to be an asset. I'm just going to put an A there. Office supplies, likewise, the business is going to use these office supplies into the future. So that's an asset. Note payable, as the name denotes, it's something that the business owns. So it's a liability. A rent expense, it tells you there, it's an expense. So actually I didn't put that in my list. I'm going to put expenses and revenue in the list also, besides assets and liabilities. We need to define revenue, and we need to define what is an expense. So rent expense is an expense. Cash is an asset. So cash is something that you will have, that you will use into the future, a resource, so that's an asset. A. Wilson withdrawals, so that's part of owner's equity. So that's the money that J. Wilson will take out of the company, or has taken out of the company. So that's going to be owner's equity account. Service revenue, as the name says, it's a revenue. So it's revenue that the business has earned. Accounts receivable. So accounts receivable is money that our clients owe us. And so accounts receivable is an asset. It's something that we are going to, it's a resource that we are going to turn into cash into the future. Accounts payable is money that we owe our suppliers. So it's the opposite of accounts receivable. So accounts payable, we owe, so it's a liability, whereas accounts receivable is something our customers owe us. So it's an asset to us, whereas accounts payable, we owe. J. Wilson Capital, notice that it's June 1st, so it's not giving us the June 30th balance, it's giving us the beginning of the month balance. That's an owner's equity account. And salaries expense, as the name says, it's an expense. So there's a really good description of assets, liabilities, owner's equity, and it will be in your e-text, or it's also on, if you have a hard copy text, it starts on page 13, 14, 15, you'll see. So it's good to look at all of the accounts, and these are some of the main ones that we'll use in this course, but there are others. And so take a look at that in the e-text or in the textbook to look at the description of all these accounts. So now that we know what they are, we can prepare our statements because we can pick out which accounts go on which statements. So let's look at the income statement first, and they have to go in this order, and you'll see why in a minute. The income statement has to be the first statement that you produce because we need to know the net income so that we can produce the next statement. So let's take a look at that in a minute. It says to prepare the statement for Wilson Towing Service for the month ending June 30th. So an income statement, it's always for a period of time, and this is telling us it's for 1 month. So the first three lines of the income statement are going to be it's going to define the name of the company. So Wilson Towing Service, that's the name of the company, always goes on the first line of a financial statement. The type of statement that we're preparing, in this case, it's an income statement, and it's for the month ended June 30th. So they told us the period of time is for the month of June. So that's why it's for the month ended. So we're showing them that, these are the revenue and the expenses that Wilson Towing Service has had for the month. What goes on the income statement? Revenue and expenses. So that's what we show on an income statement. First, we show revenue. So if we look up here, we'll see the only account that we had with revenue is this 15,000 service revenue account. So that's the first one that we're going to specify here in our income statement. And we will show revenue on the first line. And on the second line, we'll show the type of revenue, service revenue, $15,000. It's the only revenue that we have, so we don't have to total it because that's all that we have. The next thing that goes on the statement is expenses. So let's look at the expenses. We have, what have we defined here? We've defined a rent expense. And if we come down the other column here, we had a salaries expense. So we have a rent expense of $900, salaries expense $2,400. So that's what goes next in our statement. So here we list our heading is called expenses. We have salaries expense, we have rent expense, and then we show the total expense, so $3,300. So you'll notice that this underline here is saying that I'm taking $2,400, I'm adding $900 to get this $3,300. So this $3,300 is a total, and we put this underline here to say that we are doing a calculation. So in this case, it's $2,400 plus $900. So we have our service revenue, $15,000. We have our total expenses of $3,300. Our net income is the difference between those. So we take our service revenue, we subtract our expenses of $3,300, and that gives us our $11,700 net income. So that's the income that the business has earned in that month of June. So they had this revenue, they had all these expenses, and that's the amount that they get to use in some method. You'll notice that there's a dollar sign at the beginning on the top and a dollar sign at the beginning of a column, also a dollar sign at the end. And it's kind of hard to see here, but there's a double underline under net income. So that means this is the final number for this statement. 11,700 is the final, and we double underline it. This line under 3,300 says that we are doing a calculation. So we're taking 15,000, subtracting 3,300 to get our $11,700. So that's showing that it's a calculation, and 11,700 is our final number. So that is the income statement: revenue, expenses, net income. The next statement that we're going to prepare is the statement of owner's equity. And again, it's for a month. So it's for the month ending June 30th. They also give us a little extra information. Assume Wilson invested $11,000 during June. So they started off with, you'll see the owner's equity. They're telling us J. Wilson Capital. So you always start with the owner's name, J. Wilson, comma, capital is the capital account. And it's starting off with $32.50. So at the beginning of the month, the owner's equity account was $32.50. But they're telling us that during the month, the owner invested $11,000. So let's start off again with our three headings. So it's Wilson Towing Service, again, the name of the company, what statement we're producing, statement of owner's equity, and it's for the month ending June 30th, 2020. So it's telling us that we're going to show how owner's equity changed from June 1st to June 30th. So if we look here, Wilson Capital on June 30th was $3,250. So that's what they told us here. It was at the beginning of the month, it was $3,250. Then they told us that the owner invested $11,000. So we can add that. So add investment by owner, $11,000. The other item that we're going to add is this net income, because we made money. So we add our net income to the owner's equity, because after we've paid all of our expenses, this is the amount of money that's going to get added into increase owner's equity. So that's what happens with net income at the end of the accounting period. So we're going to add in our net income for the month, 11,700, and then we'll take a subtotal for all of the adds here. So we started off with June 1st, $32.50. We added in $11,000 for the investment, $11,700 for the net income, and that totals $25,950. But we also have a withdrawal. So if you look here, we identified another owner's equity account. So this is the only other one that we have for owner's equity. J. Wilson withdrawals. So the owner withdrew $3,500. So we also have to subtract that. So let's get that. So less withdrawals by owner, $3,500, leaves us with J. Wilson Capital at June 30th at the end of the month at $22,450. So the statement of owner's equity is showing what the amount was at the beginning. You add in any investments that the owner made, if they did. Sometimes they may not add an investment in a month. You add in the net income. So that's why this statement has to be prepared after the income statement. We get our subtotal, $25,950. We take away any withdrawals. So the owner has taken out $3,500 from the business, and we're left with a capital of $22,450. Also notice the dollar sign at the beginning, the dollar sign at the end, the double underline at the very last amount. So the J. Wilson Capital has to have a double underline. And anywhere that you're adding or subtracting, you're putting a single underline. So here we're adding these three figures to get this. Here we're taking $25,950 and subtracting $3,500. So it's hard to see here, but you would have a little, a single underline under here. And then you have your $22,450 is your final number. So that's a statement of owner's equity. And we're going to go on and produce our last statement, which is our balance sheet. So we're going to prepare the balance sheet for Wilson Towing Service as of June 30th. So you'll notice they're not saying for the month of June, they're saying as of a point in time. So the balance sheet is always a point in time. It's not for any particular period. When you look at a balance sheet, you can't tell, you know, it's over no period of time. It's just telling you what your assets, your liabilities, and your owner's equity are as of a particular date. The balance sheet reports assets, liabilities, and owner's equity. So it's that accounting equation, assets equals liabilities plus owner's equity. So that's what the balance sheet is showing. Assets equals liabilities plus owner's equity. So we're going to put all of our assets on this side. We're going to put our liabilities and owner's equity on this side, and they have to equal. So you'll know that, you know, you're pretty well sure you're right if they equal. So first of all, we're going to have our three lines. So this is the name of our company. We are producing the balance sheet, and it's as at June 30th. So it's not for a particular period of time like this one shows, where the month ended. It's just balance sheet June 30th. We are going to first put our assets, like I said, on this side. So if we come up and we'll look at what we tagged as assets. We had equipment, we had office supplies, we had cash, and we have accounts receivable. So they are the four assets that we need to put in our statement. So let's come down and we're going to list four of those assets with their values. So we have our cash, $1,400, our accounts receivable, $9,000, office supplies, $1,000, and equipment, $25,850. And then we will put our total assets. So there's our total assets, $37,250, dollar sign at the top, dollar sign at the bottom, a single underline to say that we're adding these four numbers, and our double underline, our total assets. The order that they go in with the accounting standards for private enterprise, ASPE, we list them in order of liquidity. So what that means is cash is closest to cash, is cash, so cash comes first. And then we order them in the order of which ones will be converted to cash the earliest. So accounts receivable is what our customers owe us. So, you know, usually we'll give our customers, you know, 30 days or so to pay their accounts. So that should, you know, come in very quickly, our accounts receivable. So it's closest to cash. Office supplies are, you know, supplies that we're going to use over a period of months. So that may come next. And then equipment, these are, equipment is what we're going to use in our business, usually over a long period of time. So we buy equipment and we have it. We don't, we're not buying and selling equipment. We're using that equipment in our business. So it's the least liquid. It's not going to be converted to cash for a long time. So that's the order that they come in. Next over here, we're going to have list our liabilities is going to be the next section. So let's go up and see what liabilities. Liabilities are what we owe. And what did we tag here? We tagged a note payable. So we owe that perhaps to a bank or something like that. And we have our accounts payable. So we have $8,000. So we have two liabilities. Accounts payable is what we owe our suppliers. So the folks that we buy things from. So we're going to list those two liabilities. So we have accounts payable, we have note payable, and we have total liabilities. Again, you'll see the dollar sign and the single underline because we're adding up our liabilities. Accounts payable is going to come first because we typically, our suppliers will give us 30 days to pay. So it's going to come first, and usually a note payable, you'd have to know the terms, but it's, it could be typically a few months or it could be a year. So you would know, which, how long it will take you, that you have to pay that back, but typically it's longer than accounts payable. So that's the order. Then we have our total liabilities. So there's our 14.8. Next we have our owner's equity. So assets equals liabilities plus owner's equity. So we're going to have a heading called owner's equity. And J. Wilson Capital is going to come from the statement that we just prepared. So we said at the end of the month, after we add in our investment, after we take our net income into account, we take our withdrawals into account, we had $22,450 left at the end of the month. That's our total. So we take our total, J. Wilson Capital, $22.40. So that comes from our statement of owner's equity. Then if we add our liabilities and our capital, we better come up with the total of our assets because assets equals liabilities plus owner's equity. So here our assets are $37,250. Our liabilities plus our owner's equity, so our $14,800 plus our $22,450 gives us our $37,250 total liabilities and owner's equity. And there's our total. Total assets equals total liabilities plus owner's equity. So we are balanced. So that is our three main financial statements. They are three ones that we mainly prepare. The income statement, the statement of owner's equity, and the balance sheet. Again, I'm Danielle Keynes for Accounting 1030, E1-14 to E1-16. Thank you.